Welcome to this explainer. Today, we are demystifying an absolute powerhouse of an engine for building generational wealth. And yeah, we're talking about the stock market. We're going to build out a step-by-step framework so you can finally put your money to work and, honestly, stop leaving your financial future up to chance.
Okay, let's dive into this. 8.5%. That recent inflation rate represents a pretty harsh reality for anyone who thinks just hoarding cash is enough. I mean, look, if you keep your hard-earned money stuffed under a mattress or, just sitting completely idle in a closet somewhere, it might feel incredibly safe. But the reality? It's literally losing its purchasing power because every single year the cost of living creeps up. That means your idle cash just buys you less and less. So, unfortunately, savers are kind of the losers in a high inflation environment.
But here is the ultimate counterattack. Historically, the stock market has returned an average of 10% annually. 10%! This is your shield against that inflation. And more importantly, it unlocks what Albert Einstein famously called the eighth wonder of the world, compound interest, which is really just a fancy way of saying your interest is earning its own interest. To put that into perspective, over a 30-year horizon, a $10,000 investment just sitting in cash, well, it remains exactly $10,000. But growing at a historical 10% stock market rate, it transforms into over $174,000. No way, right? But that is absolutely the power of participation.
Section 1. The Foundation. What are you buying?
So, before we start staring at complex charts or stressing over numbers, we have to move from this big, abstract idea of the market to the concrete reality of what an asset actually is. Simply put, a stock is a share of ownership in a business. I like to think of a company like a giant pizza. Every single share you buy is just one slice of that pizza. So when you buy shares, you're buying equity. You literally own a piece of that business, you own a piece of its future profits, and you own a piece of its growth.
And figuring out exactly how many slices are in that pizza helps us calculate a company's true overall size. In the financial world, we call this market capitalization, or just market cap for short. It's super simple to figure out. You just multiply the total shares outstanding, so all the slices, by the current share price. So let's take Apple for a quick example. They have around 16.39 billion shares outstanding. Multiply that by a share price of, let's say, roughly $163, and you get a market cap of over $2.6 trillion. Trillion with a T. That number gives you the actual price tag of the entire company, which makes it really easy to categorize different businesses by their sheer size.
Section 2. The Vehicles. Ways to participate in the market.
Okay, now that we know we're buying ownership slices, how do we actually get them into our portfolios? The good news is you've got some fantastic options or buckets to choose from. You can buy individual stocks, obviously, but you can also use things like mutual funds, index funds, or exchange-traded funds, which everyone just calls ETFs. Honestly, index funds and ETFs are brilliant because they give you a whole basket of many different stocks all at once. It's just instant, incredibly low-cost diversification. Oh, and definitely don't forget about REITs, real estate investment trusts. These are super cool because they give you exposure to income-producing real estate without you having to, go out and buy a whole office building yourself. Plus, legally, they must pay out 90% of their taxable income right back to shareholders as dividends. It's an absolutely crucial tool for building stable cash flow.
Section 3. The Toolbox. Looking under the hood. Now, what's really interesting about this slide is how we transition from abstract concepts into actual concrete financial evaluation. So how do you actually know if a specific individual stock is, well, a good deal? Listen, you absolutely do not need a fancy finance degree for this, but mastering just a few key ratios gives you a massive advantage. First up is the PE, or price-to-earnings ratio. This essentially measures a company's current share price relative to its earnings per share. It's a quick way to see if a stock is kind of cheap or maybe a bit expensive compared to its peers. Then we step it up with the PEG ratio. This takes that PE number and actually factors in the company's expected growth, which gives you a much clearer long-term picture of its value. Finally, there's ROE, or return on equity. This one is huge because it shows you exactly how efficiently a company's management team is using investors' money to actually generate a profit.
But, and this is a big but, I really want to caution you here. Statistics rarely tell the entire story. Sometimes a stock looks incredibly cheap based on these ratios, what folks in the industry call a value stock. But as the old saying goes, sometimes a value stock is really just a dog with fleas waiting for a bath. I mean, it might be cheap for a very good reason. Actually, it might just need totally new management or a completely revamped product line to turn things around. And that right there is exactly why you absolutely must do your own due diligence. You gotta look beyond the numbers. Read the news, understand the competitors, and please, I'm begging you, never just hit the buy button because of some locker room FOMO or a hot tip you got from a friend.
Section 4. The guardrails, managing investment risk. Because protecting your capital is just as important as growing it.
But before we can actually manage risk, we need to define it. What exactly is risk in the financial world? Well, simply put, risk is just the chance that your actual outcome is going to differ from your expected outcome. You go in expecting a positive return, sure, but the risk is the very real possibility that you might lose some or, hey, even all of your original investment.
And the thing is, risk comes in so many different flavors. There's market risk, which is tied to big, broad economic changes. There's inflation risk, which we literally just talked about at the beginning. But two massive ones you've really got to watch out for are concentration risk and liquidity risk. So concentration risk, that's having way too many eggs in one basket. Imagine having 99% of your net worth tied up in just one single tech stock. If that company stumbles, your entire wealth just drops off a cliff. Then there's liquidity risk. This is the danger of not being able to sell your asset quickly when you need the cash. A publicly traded stock? Highly liquid. A massive commercial real estate building in the middle of nowhere in Alaska? Yeah, that is highly illiquid.
So the crucial point is this fundamental rule: as investors, we are compensated for the level of risk that we assume. Risk and reward are forever, permanently linked. That is exactly why your standard run-of-the-mill savings account might only pay you a super safe, guaranteed 0.4%, while throwing your money at a highly volatile startup carries the very real risk of total bankruptcy, but also, the incredible potential to multiply your money many times over. Ultimately, you're the one who has to decide what level of risk actually lets you sleep well at night.
Section 5. Execution. Placing your first trade. Let's ground all this theory in reality.
And this brilliantly illustrates the actual mechanics of a trade. When you log into your brokerage platform, whichever one you use, you're usually going to be faced with two main ways to buy: a limit order and a market order. Now, a market order tells your broker to execute your trade immediately, right this second, at whatever the current market price happens to be. It's super fast, sure, but you don't control the exact penny you end up paying. A limit order, on the other hand, only executes at the exact price you specify, or better. As a beginner, you absolutely want to heavily favor limit orders. I mean, think about it. If a stock is trading at roughly $166 and you set a limit order at exactly $166, you know exactly what your entry point is going to be. No surprises. You dictate the terms.
We have covered a tremendous amount of ground today, from the pretty biting reality of inflation just eating away at your cash, all the way down to the exact mechanics of using a limit order to buy a slice of a major company. So, I'm going to leave you with this final provocative question. What is your financial horizon? And are you ready to start building your generational wealth? The stock market absolutely does not have to be some confusing mystery. With the structured foundation we've laid out for you here, you've got the building blocks you need to start exploring, analyzing, and taking real, calculated steps towards your own financial goals. Thank you so much for joining me for this explainer. Now get out there, trust your process, and seriously, start doing your due diligence.